Stealth QE, unveiling hidden liquidity injection strategies without expanding the Fed's balance sheet. Reintroducing traditional quantitative easing, QE, would exacerbate inflation, but there are three lesser-known methods to achieve the same liquidity effects without expanding the Federal Reserve's balance sheet. These methods constitute what can be termed as stealth QE, injecting liquidity into the financial system without compromising the Fed's credibility or alerting policymakers. Let's delve into these three methods. Treasury Buybacks. The first method, known as Treasury Buybacks, has already been initiated by the U.S. government. Simply put, a Treasury buyback involves the government repurchasing its debt before maturity. This may seem counterintuitive given the current $1.2 trillion deficit, but it's crucial to understand that this strategy is more about liquidity management than debt reduction. You can find detailed information on this on the U.S. Treasury's website, treasurydirect.gov, where they have published a schedule of planned buyback operations. Essentially, the government is issuing short-term, highly liquid debt to meet the high demand from institutions and individuals. This newly borrowed money is then used to repurchase older, longer-term treasuries, effectively allowing banks to offload less liquid debt in favor of more liquid, higher-interest short-term debt. Although this is a short-term solution, it serves as a liquidity injection and can be adjusted as necessary. Rule changes for bank leverage ratios. Another stealth QE method involves altering the leverage ratio rules for banks. Former Federal Reserve insider Joseph Wang has highlighted this possibility. The current rules restrict the amount of treasuries banks can hold. By changing these rules to exclude treasuries from leverage calculations, banks could potentially hold an unlimited amount of treasuries without increased regulatory risk. Given that new loans are essentially new money created, this rule change would enable banks to create money by buying U.S. treasuries, effectively acting as money printers for the government. The Federal Reserve has various facilities, like the Bank Term Funding Program, BTFP, and the discount window, which allow banks to offload treasuries to the Fed, mitigating any risk. Such a rule change would transform banks into significant facilitators of QE, allowing them to inject liquidity into the financial system by purchasing treasuries without the associated risks. Although this is not happening yet, it remains a possibility worth monitoring. Balance sheet composition shuffle. The third method, termed the balance sheet composition shuffle, has been quietly occurring. This involves the Federal Reserve altering the composition of its balance sheet rather than its size. By selling midterm maturity treasuries and purchasing more long-term ones, the Fed manages to provide liquidity without expanding its balance sheet. This strategy addresses liquidity issues related to longer-term treasuries, which have low demand. By selling shorter-term treasuries and buying longer-term ones, the Fed injects liquidity while maintaining an appearance of quantitative tightening. Stealth QE and the long-term debt cycle. While methods like treasury buybacks and balance sheet shuffles offer temporary relief, changing the rules for bank leverage ratios could provide a more lasting solution by enabling banks to continuously support government borrowing. However, these are only stopgaps in the broader context of the long-term debt cycle. Historically, similar cycles have included phases of money printing, government borrowing, increased spending, rising prices, and higher interest rates. We are currently in the early stages of such a cycle, which suggests prolonged periods of higher prices and interest rates. Conclusion. The stealth QE methods discussed here represent innovative strategies to inject liquidity into the financial system without expanding the Federal Reserve's balance sheet. While these methods provide temporary relief, they are part of a larger, cyclical process that may see higher prices and interest rates for an extended period. Keeping an eye on these developments will be crucial for understanding future economic dynamics.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.